know, there is a debate. I don't know if it's really a debate, but there's different schools, different philosophies amongst investors. Should you overweight value stocks or growth stocks? So the entire stock universe is essentially broken into thirds, where a third with the lowest valuation ratios, mostly PE ratios, those are going to be your value stocks. The middle third are going to be just your blend, where they have not really low PE ratios, but not really high PE ratios. And then your growth is the highest PE ratios. If you don't know what PE ratios are, good thing to, when you're getting into investing, learn about that. We'll throw a link in. We'll do it. It'll be here.
Already here.
We'll know where it'll be. We'll use Chris's camera.
Yeah.
So a lot of investors like to tilt towards value because if you go back, you look to the inception of a lot of the indices, you'll find that value stocks have outperformed. Kind of makes sense if all the stocks PE ratios are going to move towards some kind of median level, then the ones that are low are going to come up and the ones that are high are going to come down. It's not just as simple as like if you have a low PE ratio, raising your stock price brings that up. But for this video, that's how it works. And our firm, in general, would y'all say most everyone value tilts?
Yeah.
Maybe not even in general, just like 100% everyone value tilts.
Yeah, absolutely. Value investing, it's been around for how many years?
Yeah.
I mean, it's since the 70s. Like, you go out and you find a value company, and that's what you invest in, right?
Oh, yeah. It's been around. I'll look it up so I don't misquote this. But, okay, what has y'all's experience been value investing?
Well, my experience value investing hasn't been great because, I haven't been investing, for maybe, like actually putting a fair amount of money into investment accounts, probably like 5 or 6 years. If you look at the charts of value versus growth in the last 5 or 6 years, it hasn't been great. I'd argue it's been pretty poor. So my experience hasn't been great. I do understand that, if you go back and look at long-term trends, value will outperform growth over the long term. At least that's how it's been since, Jay, like you said, the 60s and the 70s looking back. But in my short-term experience, it has been discouraging, I would say. Jay, what do you think?
Yeah, same thing. So, I really started paying attention to the adult world and investing and everything since 2008, in which case the last 12 years, like you said, growth has really outperformed value by a large margin, in which case that's all of my adult life that I've been paying attention. Growth has been winning. So at one point, I understand that through the 80s and 90s and maybe even the 2000s, like value outperformed, but does that mean it's going to return to that? I mean, it's been now 10 or 12 years that growth is. At what point do you say, okay, now this is the new normal, and say, okay, now we need to tilt towards growth?
So for history background on value investing, Benjamin Graham and David Dodd, they were the ones that started using the concepts. They never called it value investing. They started playing with it in 1928, and they published it in 1934, their ideas. Their whole focus was finding companies at a reasonable price, and margin of safety was what they used. So basically, if I think this company that's trading at $5 is worth $10, and if I'm wrong, it's worth $3. Well, the upside is 5, the downside is only 2. That's a good margin of safety. We'll buy that stock. That's their whole premise. Ratios came in later, and that's where we are today. Like we said at the beginning of the video, it's primarily driven by PE ratios. Like if you have a low PE ratio, you're a value stock. And I think that is part of the reason why value investing doesn't work anymore, because the true classic value investors didn't really care about the ratios. When they actually started this, they didn't have standardized ratios. They were just going in and looking at a company and saying, is this priced correctly? And so you could have growth companies, by today's standards, be value companies to these investors. I think that is a huge part of what has fundamentally changed, because you have companies like Google and Apple, good examples. Tech companies, where's the value in Google and Apple? Data. It's not their buildings. Like when you're looking at railroads in 1930, it was all physical assets. How long were their tracks? How many engines did they own? What were the conditions of their machinery? How much did that cost? And then you could run these ratios. Price to book was a big one, where you say, okay, the book value of all their assets is X per share, and you're trading above or below that, and you could, have some of that. You could use those ratios more functionally. Today, data and intellectual property is nowhere on a balance sheet. There's been a lot of talk trying to get that on to company balance sheets, and I think eventually that there will be some kind of accounting for intellectual property, but today there's not. The closest thing we have is, what's it called? Blanking out.
Goodwill or whatever?
Goodwill.
Yeah.
Closest thing is goodwill, but you can't realize goodwill until you're bought.
Right.
So I'm trying to think of a tech acquisition recently. Didn't like Ford buy some electric car company or?
Yeah, split off of Tesla, right?
Oh, was that the guy that like stole stuff from Tesla?
Yeah. Yeah, like he started his own self-driving car thing, electric and everything, and then I think Ford, somebody bought them, and then
So that company was researched by Ford, and they had to value whatever the intellectual property they thought was and put that as goodwill. And so that actually is now on Ford's balance sheet, but that is frozen in time. You can't increase, you can't amortize goodwill in the United States. So, I mean, that's
a good point. So if we say it a different way, their PE ratios of these tech companies are higher than normal, and so they're put into the growth category, basically because we can't properly value their company.
right.
Exactly.
Interesting.
I think that's one issue. And I think there's another issue where we are constantly talking about the markets reverting to the mean, which is true in some way. Stock market is not truly a mean reverting. It's not a mean reverting function. It's exponential, but it does have. We do mathematically know that the stock market has a positive drift, so it's going to increase over time, and everything kind of will drift to move the same. So if you look at the stock market over the last 20 years, getting about 9% annualized growth, that's usually what you can expect any given year. We had value outperform for a long time. Isn't it growth term now?
Yeah.
Shouldn't, if you get a long enough time period, value and growth be moving the same?
That's a good point. But even with your argument of the tech companies and not being able to properly value them, that would then shift them over to the value side of the quadrant, or 9 squares, whatever. Mm-hmm. In which case, that could be an argument that value is still outperforming. It's just we have it classified incorrectly as growth. You know what I'm saying?
It's possible. And I mean, I don't know, when you're looking, the only thing I can say is to kind of counter what you're saying, play devil's advocate. If you look at the dimensions over time, it's a piece we use in our office quite often. There is this sort of rolling period where, values in favor, growth's in favor for some period of time, values back in favor, and kind of go back and forth. This might be the longest time period where one has been in favor over the other. But what's to say that value isn't going to just kind of swing back in favor? I mean, I think the biggest concern is something you brought up, Dallas, is just the fact that we don't have intellectual property on on balance sheets. I think that's a huge fundamental change in how we classify
Yeah.
companies. So that could have a huge impact going forward, like you said, on whether or not value or growth. Like you said, value could be outperforming. It's just classified wrong.
Yeah, maybe.
So it's hard to tell. But.
You know what okay, so big tangent here.
Yeah.
This reminds me, so last night I was talking with my buddy, and we're big baseball fans. And so, not a big sports guy, sorry, Dallas. But did you know that this year's batting average is down to 250?
Wow.
And you know why that is?
I'll take a guess as the least educated person here. Just less practice.
Oh, good guess. No, it has nothing to do with actual COVID or anything like that.
Oh.
In my opinion, this is my opinion. But instead, the number of shifts that everybody's putting on these players, the amount of data that these guys are acquiring on every single player that comes to the game. They know how to pitch to them. They know the best place to put their players in the field. And so it's so much harder for them to get hits. The batting average for the league keeps going down.
And I don't want to, this isn't a baseball podcast, but, you do see more and more coaches adopting that philosophy, more and more, not programs, clubs. I'm a college sports guy. I always say programs. More and more clubs adopting that strategy. You still have your old school guys that ignore the data analytics, but you do bring up a really good point. You look at the teams that have, been winning championships recently, they're all data guys. So that's pretty interesting.
So at what point does the game need to change, right? And that's, so tying it back to the stock market, at what point do we need to change to just accept these are the rules now? We have to change if we want to win. We have to change and look at 2020 going forward.
Yeah, you're talking about data. There's nothing that more data is collected on than the stock market.
Right.
Everyone has access to Yahoo Finance and can find a lot of these data points. So everything's going to get tighter and tighter, just like those batting averages. You got to hit any mistake the pitcher makes, you got to capitalize on.
Yep.
Right?
Yep.
So I don't know if we solved it, but value versus growth, we'll see what it turns out. Looks like, my opinion is I think you should put something in every box and really even weight them. I think that every box is going to have its day when talking about, value versus growth and larger companies versus smaller companies. That's where I am.
Yeah.
Just total diversification.
Yeah, at the end of the day, I still believe in diversification.